How would the global financial system change if Bitcoin became too big to fail? The answer might surprise you. Recently on the TFTC podcast, LeClair, head of research at Metaplanet, broke down how Bitcoin is slowly infiltrating traditional finance. Dylan's unique perspective comes from successfully implementing Bitcoin treasury strategies in public markets, giving him firsthand insight into how major institutions think about and interact with Bitcoin. Today we'll explore 4 key points: the threshold where Bitcoin becomes systemically important, how traditional finance products are accelerating adoption, why Wall Street is relevant to Bitcoin Street's risk models are fundamentally broken when it comes to Bitcoin, and how this integration, while controversial to some, actually strengthens Bitcoin's position. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. Let's start with Dylan's explanation of how Bitcoin could reach the point of being too big to fail and the specific market cap where things get interesting.
Ultimately, Bitcoin, Trojan horses itself to $100 trillion by becoming, part of this too big to fail liquidity complex. And that's not true at 500 billion or a trillion, but you get to 5 or 10 trillion, and Bitcoin has a 60% drawdown, and there's issues, right? And so that's where this becomes somewhat of a self-fulfilling prophecy in terms of the fiat system and it's kind of a interplay with it. So yeah, I think that this is just kind of another step in the path, step down the road. That was always inevitable, but it's just kind of another data point that we have that it's happening.
Dylan is laying out a fascinating roadmap for how Bitcoin becomes too big to fail. He points to a specific threshold when Bitcoin reaches a market cap between $5 and $10 trillion. At this scale, any major price movements would send shockwaves through the entire financial system, similar to how a housing market crash affected banks in 2008. This isn't just speculation. It's based on how interconnected financial markets become once an asset reaches a certain size. The key insight here is that Bitcoin doesn't need to replace the financial system to become untouchable. It just needs to become an essential part of it. When a 60% drawdown in Bitcoin would affect pensions, endowments, and major institutions, preventing such crashes becomes a matter of self-preservation for the system itself. This integration creates a powerful defensive mechanism. The very system that once might have wanted to stop Bitcoin becomes incentivized to protect it. We've just seen how Bitcoin reaches the too big to fail threshold, but the next piece shows exactly how traditional finance is unknowingly accelerating this process.
While, and there's maybe merit to it that, cold storage, there is merit to it that cold storage Bitcoin trumps all. The reality is this was always the path, and it is going to become financialized in a way. And, these big institutional owners will own a big chunk of the supply. And so, this option chain rolling out is going to, Bitcoin is going to be a core asset held, and it's also going to be a portfolio in all of these, pensions, endowments, institutional funds, passive flows as an income generating asset.
This clip reveals how traditional financial products are actually speeding up Bitcoin's integration into the system. While hardcore Bitcoiners emphasize self-custody, Dylan points out that institutional adoption requires familiar vehicles like ETFs and derivatives. What's particularly interesting is how Wall Street is transforming Bitcoin into something they understand, an income-generating asset. Through option strategies and financial engineering, they're creating yield where none naturally exists. This matters because it makes Bitcoin more attractive to institutional investors who need regular income streams to meet their obligations. Sup freaks, this rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. Every new financial product wrapped around Bitcoin, whether it's an ETF, a yield strategy, or an options market, creates another thread tying Bitcoin deeper into the financial fabric. We've now seen the threshold for becoming too big to fail and how traditional finance products are accelerating us toward that threshold. But what happens when Wall Street tries to apply their traditional risk models to an asset unlike anything they've seen before? Their response to Bitcoin's unique characteristics might shock you.
Bitcoin's a super unique asset, right? If you look at every other asset, puts are much more expensive than calls, right? If you want to buy S&P 500 puts 20% below the market versus 20% calls and 20% above, the volatility that's implied for these sort of options on the downside for equities, for stocks, for the S&P index is much, much more pricey. Puts are more expensive than calls. But that's not the case for Bitcoin. Often, right now, for 3-6 months out, calls have a premium. It's the only asset that can get cut in half by 50% or 60%, no problem. But also it can triple in a year.
Dylan highlights a critical mismatch between Wall Street's risk models and Bitcoin's actual behavior. In traditional markets, protecting against downside risk is usually more expensive than betting on upside. It's why put options typically cost more than calls, but Bitcoin completely breaks this pattern. It's the only major asset that can both crash 50% and triple in value within the same year, and do so repeatedly. This insight reveals a deeper truth about Wall Street's preparation for Bitcoin. Their entire risk management framework is built for assets that behave predictably. The financial industry has spent decades developing sophisticated models for handling market movements, but these models assume assets follow certain patterns. Bitcoin's ability to make explosive moves in both directions isn't just an interesting characteristic, it's a fundamental challenge to how Wall Street operates. What we're seeing is that rather than Bitcoin adapting to fit Wall Street's models, Wall Street will need to adapt to Bitcoin. But how does this integration process continue despite skepticism from traditional finance titans? The answer lies in our final clip.
Maybe someone like Buffett would say it's all fluff, and that's fair enough. But to that end, if that's the case, and the majority of your enterprise value is kind of this intangible network effect that investors are valuing. It's a rational decision to dilute, quote unquote, dilute and get some of that treasury into cold hard Bitcoin. That's not going anywhere. That's not going to fade because of a competing network effect or a dwindling moat.
This final piece brings everything full circle, showing how even the staunchest critics of Bitcoin within traditional finance are being forced to evolve their thinking. Dylan makes a brilliant connection to how the market already values intangible network effects in major companies. Just as Warren Buffett had to adapt his value investing framework to account for tech companies with massive network effects but little physical assets, the financial system is beginning to recognize Bitcoin's network value. The willingness of companies to dilute their shares or take on debt to acquire Bitcoin isn't just a trendy treasury management strategy. It's evidence that Bitcoin is being accepted as a legitimate reserve asset. This shift in corporate behavior is particularly significant because it shows how traditional finance isn't just integrating Bitcoin through products like ETFs and derivatives, but through fundamental changes in how they think about and value assets. Each company that adds Bitcoin to their treasury brings us closer to that critical threshold where Bitcoin becomes too big to fail, and does so through the very mechanisms that traditional finance already understands and accepts. How do you think Wall Street will adapt when their risk models fail with Bitcoin? Let me know in the comments. I read every single one. And if you found this analysis of Bitcoin's integration into traditional finance interesting, you'll want to watch our breakdown about how Bitcoin and the US dollar might coexist. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.